Hello and welcome to our third lesson. We are so far and today we are going to look at special rules for entities with specified main business activities. Today we are going to look at special topic in IFRS 18, and if your company falls into this category, then stay tuned to learn something new. So, what are our learning goals? As always, we have 5 learning goals. We will start with why do certain entities need special classification rules? And what problems would occur if we don't have these rules? What evidence and analysis determine whether investing in assets is qualified for being a specified business activity for the entity? The same way, what determines whether providing financing to customers is going to be specified business activity for the entity? And how should companies assess whether they have specified main business activities, and what happens when this assessment changes? And our last objective will be to have a look what impact this has on classification in income statement. So we'll have a look to 2 types of entities, one investing in assets and the other one providing financing to customers, and see how their income statement works, how the classification and disclosure is different from main requirements that we have learned so far. Wonderful. Now let's talk about why do we need these special rules. So ISB, when published IFRS 18, it decided that to have 2 entities that will have some special rules that should be applied for their income statement presentation. And these 2 entities are the entities that invest in assets as main business activity or provide finance to customers as a main business activity. And imagine a situation if there were not the special rules present for entity that invest in assets like real estate investment trust. They would have investment in real estate, and the investment gains, losses, fair value changes, or gains, losses from selling this kind of investments, some interest expenses, maybe some dividends income, if any. This all will be presented under investing activities. Under operating activities, we would see probably some minor administrative costs, which of course would not be representative for the business, and investors analyzing the financial statements would not really get how the business really operates, because the most important activities are now under investing rather being under operating. Second situation, let's assume we have a bank. This bank provides loans to customers and of course accepts deposits so as to finance these loans. Under normal classification, loans to customers would be under investing category, and deposit interest that bank pays to investors, to customers, it would be under financing, because this is a way of financing its activities. Again, under operating, we would have very minor costs, administrative nature, which wouldn't be representative of the core business that bank has. And of course, investors just looking at the income statement, it would be very difficult to say how the bank performs, because the core main business activities are spread into ancillary categories like investing and financing, and they are not representative of the core business itself. That's why, to mitigate these drawbacks in presentation, IFRS 18 came up with some